Good morning. It's Friday, the 18th of July, and this is Govindraj Ethiraj broadcasting and streaming weekdays from Mumbai, India's financial capital. Before we start off, I'm going to be traveling for almost 9 days next week onwards, and therefore I will either be not broadcasting or be intermittent, but will be back in full flow by the 1st of August. Our top stories and themes today: why IT stocks are pulling the indices down, and an insight into the industry. The US-India trade deal imminent, says Trump again. India has sufficient options for oil imports if there are sanctions on Russia, according to the government. A top Securities and Exchange Board of India official says staggering derivative losses could have gone towards responsible investing and capital formation. And on Artificial Intelligence Appreciation Day, a look at where AgenticAI could change the way companies interact with consumers.
This is a core report with Govindraj Ethiraj.
The markets search for cues. The stock markets were once again unable to make up their mind on Thursday, searching for fresh cues and silver linings. And then there is the derivatives hangover with the Nifty 50's weekly futures and options expiry. The BSE Sensex fell 375 points to close at 82,259. The NSE Nifty 50 was down 100 points to close at 25,111. In the broader markets, the Nifty mid-cap and small cap were both down about 0.2% and 0.1% each. Foreign investor flows are positive right now, though it's not clear what that trend or how that trend could continue, but we will monitor it. Let's look at some sectors. IT services companies' results are now coming out. Wipro reported a roughly 11% year-on-year rise in net profits to about 3,330 crores for the quarter ended June 2025. That's Q1 FY26, up from about 3,000 crores for Q1 FY25. Profits declined sequentially about 6.7% from the previous quarter. That's the fourth quarter of the last financial year. Revenue from operations for the latest quarter stood at about 22,134 crores, up slightly from 21,963 crores the year before. On a sequential basis, however, revenue declined about 1.6%. Now, there is obviously much that's happening in the background, and how and what kind of deals are getting signed by major US corporations, which represent a bulk of revenue for Indian IT majors. Several import-dependent industries like retail and pharmaceuticals in the US are not clear where tariffs will land, similarly with manufacturing as a whole, all of which is having an impact on their decision-making. But let's dive into that in much more detail very shortly. On Wall Street, things were looking up on Thursday morning, and the reason why they were is important to remind ourselves on how markets are doing nowadays, if nothing else. Firstly, in the US, results have been strong. Companies ranging from Pepsi to United Airlines have delivered better than expected earnings, and quarterly earnings report released this week have exceeded Wall Street expectations, according to CNBC. It also said that among some 50 S&P components reported so far, 85% have exceeded analyst expectations, according to FactSet data. Meanwhile, the economy is also looking strong. Despite all those tariff fears, the Labor Department reported Thursday that jobless claims for the week ended July 12th were lower at about 221,000 compared to the previous week, which was 228,000. Separately, retail sales in June were also higher than expected, according to new data from the US Census Bureau. So, all of this might change as many are predicting, but at this point, both on the corporate front and on the macroeconomy front in the United States, things are looking strong. Back home, the rupee weakened as it went past a key support level on Thursday to hit a 3-week low. It closed at 86 rupees 7 paise against the US dollar, down from its close of 85 rupees 94 paise in the previous session. The dollar index was itself stronger at about 98.7. Even as traders worldwide looked at the latest comments by US President Trump about Federal Reserve Chair Jerome Powell's future. And linked to that, gold prices were down on Thursday. And just to go over what exactly happened, President Trump first suggested or seemed to suggest that he was going to fire Federal Reserve Chair Jerome Powell, something the markets don't like. And then he said that he did not plan to do so. Spot gold was down 0.6% at $3,335 an ounce. And gold futures were down to about $3,331 per ounce. This is midday Thursday. But we don't know about tomorrow, because you have to understand or try and understand the bizarreness of this all, because gold prices were up because of those reports on Wednesday that Trump was open to the idea of firing Powell, which pushed prices up by about 1.6%. And then later, of course, he said that he does not plan to sack him, but left the door open to the possibility, even as he renewed his criticism of the Federal Chief or the Federal Reserve Chief for not lowering interest rates. And that's where the crux of the battle lies. Now, let's return to Indian IT services, whose fortunes also depend to a large extent on what is happening in the United States. So, what are the key trends that are emerging from the results so far, and what is the outlook like for these larger, or for that matter, even smaller IT services companies? I spoke with Sandip Agarwal, Partner Principal Officer and Fund Manager of Sowilo Investment Managers, and I began by asking him for his key takeaways from the results so far, before also asking him for his take on valuations and outlook.
So, the results are coming on expected lines. So, it was known that due to confusion on tariff and some challenges in the US economy, which are not clear whether how tough the economy will land, whether it will be hard landing, soft landing, whatever. So, because of all this reason, it was known that the discretionary part of the Indian IT spend that will take a backseat. And just for to keep the context right, discretionary part is a smaller portion, but that is very important for growth because that is what brings growth. The repeat business is generally the steady state business, which gives you 90% of the business. So that was known. And I think if you see TCS missed on revenues, maintained margins somehow, HCL Tech had a bigger miss on margins. So, the mixed results of TCS missed on revenues, maintained margins, HCL Tech missed on margins, and the guidance of margin is also lower. And Wipro, we have seen, is okay on all fronts. Tech Mahindra was also more or less decent, but their deal wins were stronger. So we are seeing some little mixed kind of result. But let me tell you this, that, this is now a mature industry. So expecting more than 6-7% growth in the large names is going to be challenging for two reasons. One, this agentic AI is really, really destroying the amount of efforts required to do the work. So basically, you can't build the same number of effort. So even if you are able to build the same efforts or you are able to keep your revenue flat, it is a great task in next 3 to 5 years. So I don't see this industry growing more than 5-6% over next 4-5 years. And the large caps will be challenging to beat that number.
Right. I'll come back to the overall growth prospects. But if you look at, some of the specific industries that these companies are dealing with. So, for example, retail, pharmaceuticals, manufacturing, many of these are linked to some kind of tariff issue or the other, because the supply chain, retail, of course, is dependent on imports. So there is uncertainty there. Are there industries, and I'm guessing it could include financial, which are less affected by the whole tariff uncertainty right now in the US and Europe, and to that extent, maybe our Indian companies are then more hedged?
Yeah, absolutely. So if you see the results which has come till now, we have seen more pain in retail and manufacturing. And the reasons. Retail has a lot of import-driven, the supply chains are challenged and all because of the tariff war and all. And manufacturing, similarly, there is no clarity. So, and the raw materials are also linked, the supply chains are linked. So there is a challenge. Right now, we are not seeing much challenge in the telecom and the BFSI because they are more localized and not dependent on much on the global supply chain. So that is clear trend which is coming out. But let me tell you that if there is a problem which happens, then banking is finally a derivative. So it reflects your GDP, right? It reflects your growth. So it is a proxy to growth. So it will trickle down there as well. It will be very hard to defend even BFSI and telecom beyond a point.
Right. If I were to ask you the flip question, would you say that given all this, all the top IT services companies have done well?
Yeah, they have done well. I won't deny, because you have to remember that the biggest market, which is US, already we are at 20% penetration level in outsourcing. The market shares, if you exclude the BPO part, we are at 96-97%. So what more you can achieve it? They have done the best they can do and they are doing the best they can do. The only thing is that, what is happening in this industry is that if you see post-COVID, there was a bunch up of spend which came 12, 13%, 15% 1 year, rewarded everyone. But otherwise, this is a 6-7% growth industry only because there is so much only which can be outsourced now.
Right. And, one of the things that maybe triggered the growth concerns for the industry, which is to come back to the larger growth question, is the Accenture results, which came last month. And that seemed to suggest for the first time that, deals were not likely to go the way people thought they would. What are the signals that you see or look for when you assess how the near-term future looks like?
No, so you are spot on. So Accenture results, they were clear. First time it has happened that outsourcing order book was low. The growth was lower. There was a deceleration. There was no conviction in the CEO's commentary also. I think after almost 25, 26 quarters, which is like 6, 7 years, I have seen that, the outsourcing book has seen challenge. And that was clear signal that the numbers for us won't be good. I think, going forward also, I believe that the way efforts are being getting killed by the new technology, it will be hard to grow. And even a 5-6% growth will be a very good growth. To be honest, see, Accenture growth is large, has a very huge component of inorganic also. So despite that, the numbers are very poor if you compare. So we are doing phenomenally better than them. But the question is that, no one is bound to be invested in a particular sector. So if you don't get growth, you have a choice to flip. So I think it is the new FMCG. The good part when I speak to a lot of investors here is that they are saying that if you are paying 50 multiple for FMCG, which is going to grow at 4-5%, better to pay for 25 times for IT, it will also grow at 5-6%. So that trade definitely is there.
Which I guess brings us to the next logical question. So how would you then look at valuations in IT stocks?
There are two ways to look at it. One, I think this is a mature industry. 5-6% revenue growth is going to happen for the large names in next 4-5 years. You exclude ER&D companies like KPITs, Tata Elxsis, LTTS and all that persistent because ER&D as an industry is going at double the rate of IT services. So these companies will do better. And then there are some companies which are very small, and because they are very small and they have quickly, moved into AI and others, they are going to grow even better. The problem is that everyone knows everything. So the challenge is that people are assigning 25 times to the companies which are growing at 6-7%, 40 times to the ones which are growing at 12-13%, and 50-60 times to those which can grow at 20%. So the peg ratios are very, very stretched. And I think, these peg ratios can only be justified if you are shifting from some other expensive sector, which is FMCG in my view, to this sector. Then you can definitely say, okay, I brought down my average peg ratio by shifting from FMCG to the IT sector. I think that trade definitely is there. Other than that, I honestly, as a fund manager, won't pay 25 multiple or 4-5 peg ratio for a mature industry. It will be very tough for me to do.
Right. And you referred to AR&D, the smaller companies. Can you define that?
So ER&D is the engineering research and development company. So the way we saw IT services outsourcing, same kind of outsourcing is now happening in the non-software services side. So basically the mechanical engineering, the electronic engineering, all those spaces. So the companies which are specialized in automotive sector like KPITs, the Tata Elxsis, the LTTS, off-highway equipment, the aerospace, all these industries, there the growth is much better. The industry growth itself is 2.5 times of the IT services. So that industry will grow at, let's say, 12, 13, 14%. And these companies which we are talking about can grow even 2-3% higher than that. But the problem is that now they are also at 40 times multiple. So, for 14% growth with 40 multiple. And the second challenge which you have to remember is that we have been big beneficiary of rupee depreciation every year. Now we don't know whether that will happen because crude is on a structural downturn. If your margins are not helped by currency and you have a natural wage hike pressure every year, which takes away 80-90 basis points. So we are saying 6-7% growth and 80-90 basis point margin decline. Then we are basically coming to 2-3% EPS growth kind of situation for the large names, maybe 7-8-10% for the mid-size and 15% for the smaller ones. And if you now place the peg ratios, they are like astronomically high. So that is my key worry in this.
So engineering R&D is something that the large companies also do, whether it's TCS or HCL or Wipro. Yet you're saying that because these companies, the other ones you mentioned like KPIT and Persistent are smaller and focused, enjoy higher multiples and valuations.
Absolutely, you are right. So HCL Tech has a very big R&D and product engineering business, more than $1 billion. The challenge is that, in the overall scheme of things, it is still like, 12, 13, 15% for each one of them. Now, compared to that, this KPITs, the LTTS, the Tata Elxsis, they will have 70-80%. So 70-80% growing at 15-20% is a different overall growth number, and 12-15% growing at 20% is a different growth number. So that is the key reason why, the growth rates, as I said, will be 5-6-7% for the large, the mid will be 10, 8, 10, 12, and the small will be 15, 20. So that is the reason it is deriving. It is a mathematics.
Therefore, should we be recategorizing because information technology services is not the same as engineering research and development? We seem to be looking at them in the same bucket.
Yes, because see, earlier the proportion of ER&D and BPO was very, very small. So everything was clubbed together. NASCOM also used to give together. But now it is very clear ER&D is different business, BPO is different business, and IT services is different business.
Right. Last question. We finished one quarter this year. How are you seeing IT services in specific and overall growth in technology linked businesses in the next quarter or two?
So see, we predominantly are a first half driven industry in India because the third quarter is a furlough quarter, December quarter, because of the holidays, the manufacturing furloughs are very high. So you can't do beyond, even if the environment improves, you can't post strong revenue growth because 3 to 4 days are lost in holidays. And then you are followed by fourth quarter when February has less number of working days. So we are a first half dependent industry. And first half, I think, is gone. So whatever these companies do, the best number will be second quarter. And I don't see second quarter to be great because the commentaries are very, 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 very cautious right now. So I think FY26 is a washout. If something happens, it will happen in first half of FY27.
Got it. Sandip, thank you so much for joining me.
Thank you. Thank you so much.
The perils of short-term derivatives. Short-term derivatives are dominating the domestic equity derivatives landscape, which could have adverse consequences, according to Anant Narayan Ji, the whole-time member and a senior Securities and Exchange Board of India official who spoke on Thursday. He said that unlike longer-term derivatives, short-term derivative products such as expiry day trading in index options may detract from capital formation. He said at a CII conclave in a report quoted by Business Standard. He said that we recognize the potential concerns of market infrastructure institutions, brokers, and other intermediaries whose revenues may depend heavily on these short-term derivative volumes. But we must ask ourselves collectively, is all this at all sustainable? He also added that the turnover in index options is often 350 times or more than the turnover in the underlying cash market, creating an imbalance. A Sebi study, as we've been quoting frequently here on the core report, has pointed out that 9 out of 10 individual traders in the F&O segment last year lost money, and those losses crossed 100,000 crore rupees or 1 trillion rupees. Narayan also said that these staggering retail losses were a large sum of money that could have otherwise gone towards responsible investing and capital formation, and added that the current structure is not sustainable for any stakeholder. And this is something that other institutional brokers are also now saying publicly, including Kotak Securities, who we spoke to just a day ago. Narayan of Sebi said that while derivatives were vital for price discovery, hedging, and market depth, certain trends in the ecosystem have warranted a closer look by Sebi. The larger problem, in some ways, if you want to call it that, has been triggered by high-frequency trading firms who are also called algo traders, and most of them are powered by a combination of very high-powered machines and very smart traders, but mostly sitting on Wall Street and typically sitting on the other side of fairly gullible retail investors right here. And here's a message from a sponsor. Want smarter investing at your fingertips? With InvestingPro, get real-time market data, custom alerts, and global financial insights all in one place. Join 46 million users already making sharper decisions. Download InvestingPro today. More details in the link below. India can manage Russian sanctions. India is confident of meeting its oil needs from alternative sources if Russian supplies are hit by secondary sanctions, Reuters quoted India's oil minister Hardeep Singh Puri saying on Thursday. President Donald Trump had warned that countries purchasing Russian exports could face sanctions if Moscow fails to reach a peace agreement with Ukraine within 50 days. India should be able to deal with any problems with Russian imports by seeking supplies from other countries, the minister said, adding that India has diversified the sources of supply, and we've gone, I think, from about 27 countries we used to buy to about 40 countries now. He also said there were new supplies coming into the market like Guyana and existing producers from Brazil and Canada. India is also increasing exploration and production activities. He said that, I'm not worried at all. If something happens, we'll deal with it. Speaking of deals, the United States is very close to a trade deal with India, while an agreement could possibly be reached with Europe as well. But it's too early to see whether a deal could be reached with Canada, according to President Donald Trump, in an interview aired on Real America's Voice on Wednesday, reported by Reuters. He also said, or it suggested, that a majority of countries, which is about 150, could see tariffs between 10 to 15% on their exports into the USA. Now, while those might be the majority of countries, those don't necessarily represent the bulk of trade imports. We are very close to India and could possibly make a deal with the EU, Trump said when asked which trade deals were on the horizon. An Indian trade delegation arrived in Washington on Monday for fresh talks and asked about the prospects of a deal with Canada, which, like the EU, is readying countermeasures if talks with the US fail to produce a deal. Trump said too soon to say. There is no word from India officially as yet, which is somewhat expected. AI Appreciation Day. July 16th, or the day before, was AI Appreciation Day. AI is artificial intelligence. It celebrates the transformative power of AI in shaping our world, honored researchers, engineers, and visionaries who advance AI technologies. And also, this is a time to reflect on ethical AI development, which would ensure inclusivity and fairness, which makes it a good time to walk through the quick transition we've seen in India in AI, starting in 2023 with Gen AI and onto Agentic AI, almost a buzzword now. But Agentic AI is also what you see in your interactions as a customer with many consumer-facing organizations. In 2025, 25% of enterprises that use Gen AI will likely launch Agentic AI pilots or proof of concept, growing to 50% in 2027, according to a report by consulting firm Deloitte. I spoke with Ashvin Velodi, partner and chief strategy and innovation officer consulting at Deloitte Asia Pacific based out of Bangalore. And I began by asking him what AI Appreciation Day was all about, including the concerns on the journey so far.
I think first off, as you said, this AI Appreciation Day, it kind of puts in context how technologies, once they are embraced by consumers and then by professionals and enterprises, it can have long-lasting impact. So this is one such technology that I see a lot of potential here. And I think the fun is ahead of us. A lot of the possibilities are ahead of us as we explore this AI journey. And you brought up both points. One is the positive aspects of how this is possible. The other one, rightly so, Govind, is we must run this responsibly. This set of technology, AI, Gen AI, Agentic AI, we must run it responsibly and we must run it with all the right transparency, governance, ethics, privacy in it. So those are the two aspects.
Right. And if I were to now ask you about the application as you're seeing it today at the enterprise level, I know that AI and its successive technologies, which is Agentic AI, which we're going to dwell upon, is now covering a wide swath of verticals in companies. It could be R&D, manufacturing, sales, supply chain, distribution, retail, and so on. So where are you seeing it have the maximum impact at this point, or the maximum relevance at this point? And in what kind of industries, if there is such a distinction?
So I'll do two things. I think, see, if you paint it with a very broader brush, AI, that is now fairly pervasive in all organizations. If you step back and go 4 years back to today, the use of machine learning ops, artificial intelligence tools on search, summarize, models, simulation, all of that is quite prevalent. So what I'll do is, so that is actually, from my perspective, it's quite widespread. AI, it is across industries and it is used for quite a few things. One is for analysis, insights, recommendations, and asking. Then the next evolution, if I take a segue, is Gen AI, which is about generating new content, generating new points of view, all of that part of the things. That also is reasonably well entrenched in typical use case. I'll give an example of Gen AI in marketing and branding, for example. An oft repeated challenge is, look, I got a certain mandate from a client. I have to run this agency copy across multiple mediums and formats. I have this brief, but I need to now tailor it to 10 different scenarios with 50 different SKUs in a quick turnaround time of, let's say, 2 weeks. Now, earlier, automation was there. It was doing all this good stuff. But today, what's happened with Gen AI is that ability to create replicable content, similar content with slight variations, giving the client, in this case, the brand company, endless choices on what's possible. Right? So that is one way Gen AI has added value. Now you fast track it a little bit towards here and now, which is Agentic AI, which is one more step ahead of this technology. And there, what I see, Govind, is all key areas, customer service, fraud detection, supply chain management, inventory management, and taking action. The only big difference that has moved, which is quite substantial in my view, is Agentic will help you not only create content, think through stuff, but also take action. This is a big distinction in how the technology has leapfrogged from Gen AI to Agentic AI.
And what's the use case that comes to mind first when you talk about this level of intervention or response by an Agentic AI setup?
So I'll give you a couple of examples. Let's say you and I buy things online and something has happened in customer service. You write an email, look, I was to this, whatever this marketplace that you bought this from. You say, look, this delivery was expected today and I am not seeing anything. What do I do as a customer? So this is just one use case for customer service. So easily now today, earlier the follow-ups, the triage, the mechanism to resolve, all that would be done by a mix of automation and humans. What agentic AI is already doing in this use case is it's able to handle the query. It's able to understand human language. It's able to realize that, look, the shipping routes have got delayed, figure out alternate shipping routes, book that shipping, get it to the customer, and without anyone instructing, offer a discount as a promo for the next purchase, and then send an NPS survey to that customer saying, are you happy at the end of the day? Look at the power of that. So the possibilities of this will be twofold in my view. This is one such. You have similar things in supply chain management on how supplies can be, or the inventory management, production planning, scheduling, all can be managed. You have things in financial fraud detection. We see clients across every sector. Financial services are really embracing it. ITES, the service industry. You have got things in manufacturing that people are exploring these ideas. On the agentic side, I'm narrowing it down to agentic. Okay, so that's what I see, and use cases abound. And it's early days, but the best is yet to come on the agentic field.
Right. And, you've argued in this paper that you've put out that, as you scale up, you also have to be ready as an organization, assuming you're already at an agentic AI level and you're still not at a Gen AI level, which many organizations would be passing through, which means more exposure. You've talked about APIs and connectivity and things like that. So what is the necessity, the positive, and the challenge?
So I'll just flip that a little bit. I think Gen AI precedes agentic AI. So just after contextualizing that, right, I think, see, what will happen, Govind, in my view, is that, all of these technologies is like a speed motorbike. You can ride it, you can get extreme thrill out of it, but it has to have guardrails. So the guardrails in this case, to my mind, is quite simple. Okay, you got to have few things enterprises must have. They must already have connected systems. They must have proper governance, which folks like us at Deloitte excel at. Proper governance of managing how an AI or an agentic AI agents will interact seamlessly with humans in the middle of the process. And third, they must have proper responsible AI, and I'll break it down. Responsible AI is transparent. What it means is there is explainability of what that agent did. So you and I are able to look at it, see that, look, what it's thinking, what is called the reasoning process, is able to reason like you and I reason. And a human should be able to read it and say, oh, I agree with that. So that's explainability. Then there is a concept of observability. You must be able to observe what happened. And last two pillars are basic privacy, so that the right information goes to the right person or the right companies, between two companies, let's say, and the incorrect information doesn't go. And the last point is what is called model hallucination. So you want to be very clear by using proper tools and techniques and calling in the experts, in my view, to manage model hallucination. Okay, so that it doesn't reflect biases that may have unconsciously crept in. So that's how you balance the pros, which is a lot of the art of possible and amazing possibilities, with the cons, which is these things that, may create a cascading effect, which may downplay or put a dampener into all the possibilities.
Right. And last couple of questions. So one is the same example that you used about package getting rerouted. And a lot of agentic AI, as I can see from what you're saying, is customer facing, at least at this stage. What happens when something goes wrong? I mean, will the system ever find out, or at what stage does it find out, and what happens after that?
That's a great point. What we recommend as Deloitte, and that's generally considered as best practice, is all these processes. See, these are all multi-step processes. The use case I painted to you. There has to be what we'll call a human in the middle. We don't recommend any process to be fully done by agents with no care in the world. That's not the recommendations. The approach is you have what is called basic maker-checker philosophies. You have the process is done, let's say, by agents, but you have a human to check and validate. Then there is a concept of when something goes wrong, there are enough checks and balances in two ways. One is the governance principles that I called out. The other is the automation itself to call out, look, there has been a problem in this thing. And it has the ability to flag. It has the ability to call out an exception. The humans will get into at that step and take the right action to mitigate or to clear or to self-heal, whatever the options will be. So it is never, we strongly suggest to not run this like completely like an autonomous vehicle. It's going to be human in the middle with the ability to, as they say in some football analogy, call an audible and say, look, you know what, we got to step in.
Got it. And I assume that being allows you to do many more transactions than you would have otherwise done. Last question. So we are in 2025. So by next AI Experience Day, what is the one thing that could have changed for the better and maybe one thing which may not have?
What my hope is that, especially in India, we use AgenticAI or AI and its tool set for unlocking the tremendous possibilities that India is faced with. It's already got a UPI stack, it's got data, it's got a government program that embraces AI. How best we can leverage to make most across the citizen services that folks are being offered, and what's the best value it can do both for that and also for enterprises to give better results, to do perform better. So that's something, and I'm pretty confident that that will happen. You have, as they say, all the makings of a perfect storm. So hopefully that thing really comes through. It's very, very clear to me that critical thinking, the ability for humans like all of us on the call, it is that much more valuable today than it was ever before. You got to have the ability to creatively think, to critically think, analyze, and solve problems. Only then these tools at the hands of creative and critical thinkers will unleash its power. So we can't outsource that part to anyone. So I hope that doesn't become the norm, that look, hey, I don't want to think. I'm just going to use this thing to do so. It's not that. It's a tool. It's an enabler. It's not the other way around. So that's something we have to keep being alert for.
That's a good note to end on. Ashwin, thank you so much for joining me.
Thank you. Thank you, Gaurav.
Well, it's Friday and it's time for your feedback. Some of you have sent fairly long but pertinent responses or letters, so I will go through them. I may paraphrase a little bit for brevity, so the editing is mine, and if any mistakes that emerge out of it, again, the fault is mine. So let me start. S. Bhaskaran says, Govind, please ask with a transparent tax expert the ways in which high net worth individuals with huge cash incomes like doctors, self-employed like beauty parlors, film industry, shift their main income to pseudo-agri projects like farms and evade income tax. And why is the government not plugging this evasion? He says he knows of a doctor who is with banana cultivation and shifts his income and evades income tax. And similarly, another area to discuss, he says, is exit tax on high net worth individuals who shift to tax havens like Dubai and Malta. Okay, Bhaskaran, what I can say is that I will take these questions or points up. Now, these are not new in themselves, and it may be a little unfair to use specifics unless I have specific evidence, but I will definitely take up the larger issue of tax shifting and whether or not some individuals could be not paying their due share of taxes by moving or shifting their main incomes to other enterprises or projects. Okay, Girish Kamath says it's not true to say that futures and options is a difficult tool alone. The problem is the Indian markets can be rigged by using arbitrage, where derivatives markets is 50 to 300 times of cash markets, and 2 shares of HDFC and ICICI account for more than 50% of the bank Nifty. This is what Girish Kamath is saying. He says that you don't even need high-frequency traders, just 3,000 to 4,000 crores on settlement day to take reverse trade in cash markets, and a simple program that can work out every combination based on calls and put at the different level. The larger point Girish is making is that unlike the United States and UK, we need to have stricter rules to get into futures and options. And what he says is that all you need is income tax returns to be filed, which you can do with nil income tax returns. He also blames some parts of media which make it appear easy, and brokers who are driving retail into this segment, and the government, of course, which is earning lots of money in securities transaction tax. Around 54,000 crores is the number he refers to. Exchanges are making money and settlement is almost every day. Well, this is something that the Securities and Exchange Board of India whole-time member also referred to, which is that there is a lot of revenue that's being made through derivatives trading by a lot of people, including government. And despite that, he feels that income that could be used for productive capital creation or capital formation is being used for derivative trading. And a lot of that money is obviously being lost by retail traders and being made by very smart institutional investors, in many cases not even in India. A special mention to listener Mihir P. Thakkar, who's been very kind with his comments and has responded to almost 3 or 4 of our interviews recently. So thank you so much, Mihir. I know you've been a regular listener and you've also been a regular contributor to our feedback section. So thank you once again for your encouragement. Thank you all of you for your encouragement and your frequent feedback. We also like to extend special thanks to all our YouTube members. If you join as a member, you get early access to a lot of our content as well as member shoutouts, where you can submit questions to ask our guests. So thank you once again. And a final reminder, I'm going to be traveling for the next 9 days and will be away for about 6 or 7 days and then intermittent till I think I will resume more actively from the 2nd of August. And that's it from me for now. Thanks once again and have a great weekend. That was the Core Report with me, Govindraj Ethiraj. Do stay connected with more of our coverage at the Core. You can check out our website or sign up to our newsletter for our exclusive stories, one in-depth feature a day on www.thecore.in. Do also track us on LinkedIn, where we usually post synopses or extracts of our top stories and interviews. We would love your feedback on how we can make business more interesting and relevant, including, of course, India's vibrant manufacturing sector. So write to us at feedback@thecore.in. And thank you once again for listening.